Hi everyone, I'm Lynette Zang, Chief Market Analyst, and welcome to ITM Trading. Boy, I'll tell you what, this is a holiday season not to be forgotten. And the markets are really telling an interesting tale. One of the tales is the dysfunction that's really happening in Washington. Were you aware that the current shutdown is the third government shutdown of this year? So it's really become a tool maybe for negotiations, but what it really shows you is the level of dysfunction in Washington. Well, that's not the only place where there's dysfunction. We can look globally to Europe and to China and to Great Britain, the Brexit and all the things in Italy. All these things are happening, and what they're really showing you is global dysfunction and a slowing economy globally. This is a big problem because if the economy slows with all the debts that are on the books, how will that debt be repaid? So what it's really foretelling is probable massive defaults coming up in 2019. That's what the inverse yield curve and all of that is telling us. On the top of that, today's consumer confidence number came out, and for the second month in a row, it's declined. Now, it's still up there at very lofty levels, so that tells us that, yeah, we had great, everybody kept shopping for Christmas and everything seems on the outside to be hunky-dory. But when you look at the belly of the beast, you see a different story, and I'm going to show you that in a second. Wait until you see the patterns that I'm going to show you today. Because the real question is, who is in control of these markets? And we've talked many times in the past about the new derivative products, those ETFs that came to the fore after the CDO derivatives were crushed in 2007, 2008. What we're really dealing with here, though, is a liquidity issue, because derivatives are leverage on leverage, and so they suck the liquidity out of the markets. Let me show you this. Because what we really thought would happen, and it did happen for a while, were the tax law changes, the repatriation gave the corporations a tremendous amount of money to work with to buy back stocks, etc. And in fact, the announced buybacks for this month were the second record in history. But the problem is the rise of the machines, which we've talked about, so that by a very wide margin, most of the trades that are happening on the exchanges are computer driven. And going back to those ETFs, and particularly those passive funds, all the central bank QE, quantitative easing, money for free, all that money printing, that suppressed the volatility. And I'm going to show you some changes that are happening in that right now. But you had the rise of the passive funds, and all of these different funds would buy the same names. So what did that do? It pushed the markets up higher and higher and higher. Now the reverse is happening, because we know on a global basis that the US, but globally other central banks, we've talked about it before, we'll talk about it more, are pulling back on that liquidity. We have a liquidity issue here. And that will be exemplified and exaggerated by those ETF derivatives. The IMF, the BIS, the FDIC, there have been lots of studies, and those flash crashes are caused by this herding mentality. So what we're seeing, aside from the central bank liquidity that is drying up, and they're trying to do that in a measured way, but you can see the markets are not liking it. But what we're also seeing is that there is a loss of liquidity in the futures, which is a derivative in the futures market. The liquidity in the S&P 500 futures is as low as it's been since the crisis was unfolding in 2008. This is not a good thing, people. because what it really does with those algorithmic, those computer generated trading is if there is a sellout, just like the rise didn't make any sense, okay? But just like the rise, when you have everybody rushing in, all of these computer programs rushing into a buy, now they're rushing into a sell. And what they've seen when they've done the studies on the ETFs is that just before a flash crash, boom, liquidity evaporates and it creates a doom loop. Where as the markets decline, other programs, sell programs, kick into gear, making the markets decline more. You have a doom loop. That is not a good thing if that's where you're holding your wealth. Now, what I also want you to be aware of is that oil is telling us that we are in a global slowdown. But what I love are the headlines. That CNBC, I mean, it's really the headlines that's telling the whole story. Because what does one say? The Dow S&P is on track for the worst month since February 2009. What was happening in February 2009? We were in the depth of the crisis. What happened the next month? March of 2009. Quantitative easing, money for free, kicked into gear. So on Wednesday, everybody's asking, what happened? Why did the markets go up over 1,000 points? Well, you know, that in March of 2009 was when the QE began. So part of it could be that the markets are anticipating if they have enough of a taper tantrum, maybe the central banks will reverse the quantitative tightening and raising the interest rates and running off their balance sheets, and they'll give us more QE. But part of what we saw, and they've been talking about it on mainstream media, and they've been asking, where are the pension funds rebalancing? The pension funds. So those institutions that are working with other people's money, maybe your money. Now what are they doing? They're going in and they're catching a falling knife with your money. Because the deterioration in the technicals of this market, well, wait till you see it. But it's scaring the Hades out of me. I gotta tell you, it is. So part of what was most likely happening on Wednesday was some short covering. Remember, selling stocks into a declining market and then buying them back cheaper. You make money that way. So there was likely a lot of short covering that was going on. The pensions appear to be finally rebalancing, giving some support to the markets yesterday and today. And let's face it, it could also be the plunge protection team, because these markets were looking very, very nasty, gave us a very bad present on Monday, the day before Christmas. I also love this headline. This is actually probably one of my favorite ones, and I pulled all of these today from CNBC. I changed my whole thing that I was going to do today because of what had been unfolding yesterday and today. But the Dow and S&P is having the worst December since 1931. Now I want you to think about what was happening in 1931. We were in the heart of the Depression after the 1929 stock market crash. And they used that crash and the subsequent depression to justify taking the gold, to confiscate the gold, the wealth of the citizens, to justify that. And part of me is wondering if the same thing is happening right now. Not with gold, but with all of those retirement funds, which is the lion's share of what's in those markets that the public is holding. Is this really a run-up to confiscating all of the wealth that's held in the markets? Because the other thing that was happening back then was the first section of the transition from a gold money standard to a debt-based fiat money standard. And we are transitioning from the fiat money standard, which no longer functions, into a new digital standard. And we have to feel a lot of pain before that happens. Earlier today, you saw the markets imploding and giving back a lot of the gains from yesterday. It's not where they closed. Thank you, plunge protection team. Thank you, pensions. But I will definitely point out that you need enough volume and enough reversal to shift what's happening with those algorithmic trading formulas. Is it enough? We'll see tomorrow.